Cool. Angela, you want to start off? You want me to?
Yeah, no, I will start off with once again, I just want to thank you, Tina, and your entire team for giving us this opportunity to present, all the tax incentives and the benefits that are available to not just you and your team, but also to your clients that are investing in any type of commercial use property. It doesn't matter if it's residential, short-term rental, it could be a storage facility. It doesn't matter as long as has to do with commercial property. And the other thing that most people don't understand and realize that we're going to cover today is in addition to, or even aside of, there are other tax incentives that you can actually have. And some of them being, Warren, you might cover this too, is even if you don't own the property, but you pay a lot into the capital improvements and renovations, you might actually be entitled to a cost segregation study because you paid for those as well. So, um, thank you for this opportunity. And Executive Vice President of CSSI, which has been the longest standing engineering based company that specializes in the tax incentives, done over 60,000 studies the past 24 years and has never triggered a single IRS audit. And so I want to introduce Warren Dazio, like I mentioned, who's Executive Vice President. He's going to be running through all of the big, beautiful bill write-off to everybody. And this is interactive. So if you have questions, please reach out, talk, let us be interactive with you so nothing's held off. We want to make sure that all of your questions gets answered before we get off of this call. So thank you again for this time.
Awesome. Thank you so much, Angela. I'm gonna let's see if my screen. Oh, there you go. It advances. So here's a great question. Then I'll give you the contact info for myself and Angela if you want to take a snapshot of that. But if you could deduct 30% of your building value, how much would you save on your 2025 tax return? So a deduction, if I got, say, 30% of my building and I had $1 million building, that would be a $300,000 deduction. So that's another way of saying if I have $300,000 of income and I have a $300,000 deduction, that means I pay zero on my taxes. And that's a little more than $100,000 that you could reinvest at some kind of rate of return. Even if you just put it in a CD, I called my bank and asked what was the going rate for a CD, and I can get up to about 3.75%, 3.75% on a CD. So take that 100,000, put that in a CD. At a minimum, you get 3.7 return on that. So pretty interesting kind of look at that. Here's Angela's contact information. Feel free to take a snapshot of that. You got her email and her phone number there. And I'll pop onto her screen again at the end. Here's my contact information as well. If you have any other questions or anything that we can answer for you, we'll be happy to do that. Angela and I work pretty interchangeably. Um, just want to talk a little bit about CSSI. So we offer several good tax benefits to different types of owners, and so cost segregation is the majority of what we'll talk about today. We'll touch on a few slides on Section 179D. And then R&D tax credits. R&D tax credits is not necessarily tied to real estate. Most of what we talk about is going to be tied to real estate today. But you might have a business. Let's say that I made this presentation one time to a self-storage, and I just mentioned R&D tax credit, and he said I have a steak company, and I said you have like Omaha steaks, and he said no, like tomato steaks. So he had developed a couple $1 million worth of equipment that helped these light pieces of wood fall down and get sorted and packaged and I was like, wow, well that what you're describing would qualify for an R&D tax credit. So we'll mention that. Like Angela said, we've been around for more than 20 years. I think we're in our 23rd year right now. Kind of the things that make us different from somebody else is that we offer multiple tax services and a lot of integrated solutions. So sometimes our clients might call us for an R&D tax credit, and we'll ask them, "Oh, do you own your own building?" Well, yeah, we do. Oh, you might qualify for cost seg and 179D, and vice versa. So you can kind of do it all in one place. We have done somewhere in the neighborhood north of 60,000 engineered-based studies. And an engineered-based study is kind of the gold standard of what the IRS puts out there for a cost seg study. There are a lot of different kinds. You may have seen the online versions of DIY cost seg, and that's a very much abbreviated cost seg study. It usually doesn't come with audit representation as a part of it. You have to pay extra for that. It usually doesn't include an on-site survey. We have done somewhere in the neighborhood of 60,000 of our studies in our 22 years. We've never triggered an audit, but we've had maybe 2 dozen clients in 60,000 studies, 2 dozen that were audited for other reasons. And they said, hey, they want to know about the cost seg work. And so we represent that at no additional cost for our clients. And in those audits, they've always asked us, did you visit the property? And we, as a firm, make sure that we are a third representative. Like if it's in North Dakota and we can't get to it, then we might send a third party to go document the space and pictures. And so we think that's pretty important. I think the firms that do shortcuts, that don't do site surveys, that kind of do abbreviated, don't do engineered based studies, those are kind of not the gold standard for the IRS. And we think they're leaving some things off, and we've kind of seen that as well. And the other thing that we do is we try and help tax professionals think strategically to make impactful decisions. I oftentimes will get someone that will call me and say, hey, I need a $1.5 million update to my big property. So I need a $1.5 million cost seg study. And I'll look at the Excel spreadsheet and I'll see all kinds of items that I know that they can expense as a repair. So I'll say, let me show you how to expense these things as a repair. So in this one particular case, it was a $1.2 million cost seg study and came back. No, it was 1.4. After he took my advice and wrote some things off as a repair, it was a $900,000 cost seg study. So we saved him, 500,000 right off the bat on that particular one. So just I think not all cost seg firms are made the same, and what we bring to the table is significant, and I think will add to the bigger picture. Well, the framework of my topic is the One Big Beautiful Bill, which passed last year. It passed in July, and just I'll touch on some changes from the Big Beautiful Bill, but some of the biggest changes are the core of what we do, and that would be bonus depreciation and cost segregation. And I'll touch on that. But while we're going, if I'm watching the chat box, if any of you have a question you want to ask, do the chat or jump off mute and just ask a question. It's much more interesting if y'all chime in and talk a little bit than if someone just talks the whole time. So I'll just touch on the tax changes for individuals and corporations. That had been scheduled to go up prior to the Big Beautiful Bill, and the Big Beautiful Bill kind of locks them in place. Changes in bonus depreciation, and we'll spell that out a good bit. Cost segregation and 179D energy efficiency deductions. That's what 179D is. We'll go over some real case studies and then some guidance on how tax professionals can maximize those tax benefits. Uh, um, Couple of last things. I just mentioned the repair regulations. The repair regulations are what I gave that client that they could write off some things as a repair, kind of coached them and gave them some guidelines on that. So then they didn't have to capitalize quite as much. And then, a couple of other things that we'll cover. But the individual tax rates, the One Big Beautiful Bill, y'all are kind of familiar with that now, especially if you're talking with Tina and her team about your taxes and real estate and all that good stuff. But um, it permanently extended the current tax bracket. All of these tax brackets were scheduled to go up. The One Big Beautiful Bill kind of locks them in place. It adjusted for an additional year of inflation for a couple of the tax brackets as well. The standard deductions were increased. I think they were 13,000 per person, 26 married and filing jointly, and those jumped up to 15,750 or 31,500 as a couple. So, the Big Beautiful Bill has some things in it that should help a lot of people. The estate and gift tax exemption, one of the things that happened there is it increased. I mean, if you think about, hey, I own 2 or 3 buildings and, I paid whatever, a 500,000, 1 million, maybe 2 million for your buildings. And then you got to sell those 10 years later, or if you pass away and your kids get them, the current market value of those could be much higher than when you paid for it. And so are your kids prepared to be able to get hit with those estate taxes? And That's something that bumped up and it's being indexed each year as well. And then this is going to pertain to less people, but the alternative minimum tax is certain thing that require AMT. So for example, one of those might be if I have a property outside of the U.S., but I live in the U.S. and I pay U.S. taxes, I'm forced to use AMT. So there were some changes that happened there that kind of bumped that back up as well, and help people in that situation. The biggest changes we'll talk about is the 100% bonus. It permanently extended it. What was happening, and I'll touch on the slide, it was decreasing. It was scheduled to go away next year in 2027. The new bill puts it in place at 100% until the foreseeable future. It'll take another administration and Congress to change that. And then the only way you can capture bonus on a building is if you do a cost segregation study. So we'll kind of walk through how you do all that. 179D is an energy efficiency deduction. It only pertains to new construction or a new improvement, and it has to be a commercial building. It can't be a residential rental building. It may, I think it would still qualify for a short-term rental because that's considered a commercial. It's not considered residential rental. So keep that in mind. But what the Big Beautiful Bill did was it said we're going to get rid of 179D for any buildings that start construction after June 30th of 2026. You can go back all the way to 2006, and if you were the person that did new construction, you can capture 179D, and I'll talk more about what it is. I mentioned R&D tax credits. I won't go into that, but if you are someone who does research and development in the U.S., if you don't offshore it, it's a dollar for dollar tax credit for some of the activities you would do for R&D here in the U.S. and pretty cool. The prior administration made it a little more difficult to get this benefit. The One Beautiful Bill brought it back and made it simpler to get it. And so kind of point all that out. So let's talk about cost segregation a second. And cost segregation is really what applies to your building. Basically, the IRS says you can depreciate a building two ways, straight line over 39 years in the case of a commercial building, 27 and a half in case of a long-term residential rental. Or you can break that building out into its parts and pieces and put different items in different buckets, and you can depreciate those faster. So let's talk about that for a second. But the benchmark is, 30 to 80% of the building as a tax benefit. So I shouldn't say 30 to 80%, excuse me, 3 to 8%. So if I'm looking at $1 million, somewhere between $1 million in building cost, I'm looking at 30 to 80,000 in tax savings that could generate. And it works for properties as small as 200,000. So it's even that has a good benefit. I just referred to it as the buckets that you can do. So straight line is like doing this 39-year bucket, the big bucket on top, and cost segregation is the other buckets. You're going to have some stuff in the 39-year bucket, some stuff in the 5 and 7 year bucket. 15-year QIP, I'll mention it briefly in a second, but it is an interior improvement, kind of what Angela was talking about. Even if you don't own the building and you pay for the leasehold improvements that go inside the building, QIP allows you to take bonus, and you likely could qualify for some additional kind of like a mini cost segregation study on your leasehold improvement. Sometimes they're big. Sometimes someone owns a $20 million building and somebody leasing it spends $2 million on the improvement. So I consider that a nice chunk of money that you'd be able to get significant write-offs from. And then your land improvements would be another thing that you would peel off, and that would be everything outside. 5 and 7, here's some examples of what some of those are. Your base building is kind of the structural. That's your 39 and 27 and a half year aspects. I know we talk about an HVAC system not lasting 39 years, but that's the definition the IRS gives to it. So I don't necessarily think that it all makes sense, but I can tell you what the rules are. Um, Tangible personal property is the 5 year items. In a self-storage, it would be interior wall partitions and interior doors. In an apartment complex or office, it might be carpeting or flooring, cabinets, countertops, specialty plumbing. In a dental office or a beautician's office, you're going to have lots of specialty lighting and specialty equipment. That is all something that you could accelerate as well. And pretty cool the way that works. QIP is once you have a building that's in service, say for a commercial purpose, and you decide, hey, I'm going to buy it and renovate it. As long as you're doing non-structural items, it doesn't qualify for elevator, escalator, or structural walls, but interior renovations, sheetrock, studs that are non-load bearing, lighting, plumbing, electrical, all that qualifies for QIP. It's assigned a 15-year asset, and then you can accelerate it either over its 15-year life or using bonus faster. And then land improvements, most people understand that, but dirt work that you did drainage around your property before you put the slab on it, all that stuff that you can count towards land improvements. But parking lot, striping, signs, flagpole, landscaping, light poles, fences, gates, all that good stuff. Um, so what's bonus depreciation? We talked about cost seg. You break a building out into certain parts and pieces, and you can depreciate those parts over 39 years and some parts over 5 and 15. Bonus depreciation allows you to take all of those instead of over 5 or 15 years, you get to take it in 1 year. And so what 100% bonus means is if you can identify everything within, with a recovery period of 20 years or less, then 100% of that can qualify for 100% bonus. Most people are familiar with equipment, maybe cars that you can apply bonus to. This also applies to things like crown molding and specialty lighting and specialty flooring and all those types of things. But so the Big Beautiful Bill brought back 100% bonus. In the past, you could only do new construction. In the current law, it allows you to do an acquisition or new construction. And you can also do look back studies. You can go back to 10 years from now, 20 years from now, to a building that you bought. If bonus depreciation applied then, you can put it on your tax return today and capture it now, and you don't have to amend any returns. So it's pretty cool how that plays out. Sorry about that. That's I'm babysitting and she's making herself known. Um, Section 179 is another thing that was changed, and I won't go into that too much. That's different from Section 179D, but Section 179 means that most things that it applies to are equipment, it applies to cars. If you have a commercial building and you do some exterior things to those, that might qualify for Section 179, like a new roof. You have to capitalize it, but you could take it all immediately through 179 expensing. Fire systems, some lighting, gutters, things like that are things that fall under Section 179. Acts kind of like bonus depreciation when you can speed it up. So this is what was happening for bonus depreciation. We had the different years here on the left side and where it was going. So in 2025 is where we were at. It should have been 40% bonus. 2026 was going to be 20% bonus. And 2027 it was going to go away. So what happened is the bill goes into effect, and anything that is put into service after January 19th of 2025 now qualifies for 100% bonus depreciation. And that'll stay for any building until a new administration changes. We might get the next administration that says, no, we're going to keep it as it is. So it may not change. And that's a very good thing for real estate owners and people who are buying things that they might want to accelerate the depreciation on. I'm not going to go too much into this, but there are some limitations to the Big Beautiful Bill. If you started construction or you signed a contract to buy a property before January 20th, and then you bought it after January 20th, you might have some limitations. You might have to follow some of the old laws. Instead of 100% bonus, you might be at 40% bonus, which is what, or no, 2026 would be 20% bonus. So just be aware of that. It really pertains to new construction. Someone started new construction call it November of 2024. They finished it in June of 2025. They've got to follow the old rules of bonus. So there are some limitation, and it does also apply to a signed binding contract that you sign in advance as well. So just be aware of that. The building types that benefit from cost seg is pretty much any kind of property you can think of. The only one that it doesn't is if you do have a marijuana, a cannabis plant. I mean, if you have a factory to that, the cost segregation and the bonus depreciation is a federal law, and the feds have not approved cannabis yet. I have had some situations where someone owned a warehouse growing center and then they had tenants who ran the cannabis businesses. The owner of the building could still do cost seg because they're not running the business of cannabis. But anyway, restaurants, manufacturing facilities would also likely qualify for 179D and R&D. I know we talked about short-term rentals last time. That's clearly one. And then residential rental properties like long-term rentals. I have a long-term house that I have some tenants that live in. And then I'm also invested in an apartment complex that Tina mentioned you were a client. I'm a client too because the apartment complex did cost seg on it as well. So all kinds of different ones. Couple of case studies. The apartment building on the bottom, a $1.2 million building. They saved 63,000 in tax savings. And they probably took the benefit like in 2018. So the building was 4 or 5 years old, and they still got a pretty good chunk of tax savings on top of that. The gentleman on the top was from California. He had 20 different properties. It created like a $1.2 million deduction. I asked him, I said, how much did you get from it? Oh, I got a little bit. He finally told me it was 400,000 of tax savings that he got. And during that time, it was during COVID, they were allowing a refund back on that so that they were trying to encourage more investments. Here's a self-storage example and a warehouse example. Again, great numbers. $850,000 self-storage got a $45,000 benefit. This one on the bottom, an office warehouse of 3.3 million, it got a $300,000 deduction and $120,000 tax benefit. So it's real numbers and it's real, good stuff. Um, the kind of last topic I'll talk about cost segregation, then I'll see if anybody has any questions. A good cost segregation study will give you what's called building systems. I don't know if DIY does this or not, but what this shows is what you paid for the building is your depreciable cost, but the replacement cost of that is usually a higher number. So the IRS says if you're going to replace part of your building, you can use the current replacement cost to measure that. So let's say I did a big electrical rewire and I put in some new lights and I spent 400,000. We'll call it three. Let's call it 250,000 in electrical rewires. That's a big dollar value, and most CPAs would say, "Hey, you're going to need to capitalize that. That's a big investment." Well, if you put 250,000 into 790, that is less than a third of the replacement cost of that full electrical system. The IRS says you can expense that 250,000 as repair. You don't have to capitalize it. So it's the same 30% rule with all of this. The only one that is a higher one the IRS gave us was the roof. The roof uses a 40% number. So this is a great tool for you moving forward as you do repairs. And there's a couple of big numbers are in here. Like if you look at interior framing partitions, you might not know the values of portions of that you take out. We get lots of clients that will call us and say, "Hey, I'm doing some renovations. Can you help me put a dollar value on what I'm replacing? And can I call that a repair? Do I need to capitalize that?" The flip side that does is that you might say, "Hey, I'm tearing this out and I'm throwing it away." And then the new stuff I'm doing, let's say, if I go back to this, let's say I did a $350,000 electrical rewire. That tells me that that's more than 30%. So I would have to capitalize that, but I could write off the value of everything that I was throwing in the trash. And so that we call that a partial asset disposition. I'm taking items that I'm renovating, remodeling, things of replacement. In a big building, you might abandon something in place. We had a hospital one time that had a big chiller, and it was too expensive for them to get a blowtorch and cut it up and remove it. So they just said, we're going to abandon that right there. And they put a new chiller in the building, put it in a new location. So they can write off the remaining value of that chiller that they abandoned in place. They own the building for 10 years, but it's a 39-year asset. So they get to expense Shush, shush. They get to expense the remaining value, 29 years of tax life from that. So, pretty cool how that works. Common stuff you're going to do, roof, HVAC, electrical, LED lighting projects. LED lighting projects kind of gets the best of both worlds because You can write off the lights that are going in the trash oftentimes. New lights going in sometimes will get QIP and so they get 100% bonus. And then you might also get an energy rebate from the energy company. So pretty cool. Angela mentioned some of the taxes are use it or lose it. When you do a big renovation and you throw something out, you have to tell the IRS that and capture that in the same year you do that, or you lose it moving forward. So we call it use it or lose it. You kind of see on that on one of the bottom arrows, and it's something that is working on there. So let me take a pause for a second and see if anybody has questions on cost segregation. And then I'll do a brief overview of 179D and I'll touch on R&D and then see if we have any further questions from there. Anybody have any questions? You can drop it in the chat, or if you go off mute, you can ask us a question. Anybody? Anybody? Y'all may not, y'all might be too young for this, but Bueller. Anybody
Ah,
see?
I'm not.
Any? Ferris Bueller's Day Off.
Ferris Bueller's Day Off. Yeah. So, I didn't see anything in the chat, Warren.
Cool. Yeah, and Angela, if you think of something that I'm missing, pause and we can ask that question on that as well. There's a lot of benefits there, and you really don't know until you ask. When Angela and I talk to someone that's interested in some of these services, instead of us going into what cost seg is all about, we say, "Tell me about your project." Well, I bought a building,
Right.
I've got tenants in it. I'm going to renovate it. Oh, tell me what you're going to tear out. When they start telling me things they tear out, there's something called the routine maintenance safe harbor. So I own an apartment complex. I have six tenants. As each tenant lease comes up, and I'm going to go in and refresh that unit. Oh, how often do you think you'll have to do that? Well, you got to do that every 6 or 7 years because I'm going to get new tenants and they kind of tear it up a little bit. And oh, there's a regulation that says if you know you're going to have to replace something more than once in a 10-year time frame, you can write it off as a repair. So painting, replacing carpeting, repainting countertops and appliances and maybe the cabinet faces, all that is stuff you're likely going to have to do more than once in a 10-year time frame. So the routine maintenance safe harbor is the safe harbor that allows you to expense it as a repair. So we kind of want y'all to tell us what are the things you're doing, and that triggers in us, oh, is QIP available? Is an asset disposition? Are the repair regs available?
Oh,
And allows us to kind of capture all that benefit for you. Anything else,
I
Andrew?
I have a question. So we did a COSAC last year on my commercial building. Um, I have not filed the tax on it yet because I remember, even though I did the COSAC last year, I can apply it to like this when I want to do like this year's deduction. I can do it for this year, but I don't remember if at the time it's 100% depreciation. Can some, can,
When
can
when
y'all
did you
help
buy
me
that?
figure it out?
Yeah, Tina, when did you buy that building?
Uh, at the end, when did I buy Stonehenge? It's like a year ago, like more than a year ago. It's December of 2024.
December of 2024. You probably would have to follow the old rules, but that would be in 2024, it would be 60% bonus depreciation. So you get most of it. And yeah, you could apply it on your current tax return instead of doing that in 2024. You simply file an additional form. It's called a 3115 change of accounting form. We get some people that say, I wasn't making enough money maybe to take advantage of cost segregation when I put the building into service. And then if you did the cost seg in 2025, then you can apply it to your current 2025 taxes. If you're, if you we're almost past March 15th, but if you're extending or if you can do your own tax returns, like I know some of you on this call can, then you could apply it now. But yeah, if it was December of 2024, it's probably 40% bonus.
So
No,
I bought it. That's the closing time, and then we did the COSAC last year, right, Angela? I think we did it like mid last year, and then my goal was to kind of apply it to last year's tax, in like income tax
yeah, and
depreciation.
So 2025, you can
Yeah.
still apply it to your 2025 taxes, but it follows the year, bonus follows the year you put it into service.
Right.
So if you put it
Oh,
into
gotcha.
service in 2024, you got to follow those rules. If you say, hey, I
Gotcha.
put it in service on January 20th, 2025, wink, wink, then you would get 100% bonus depreciation on
Correct.
it.
Correct. And you wouldn't have to file Form 3115 to, recapture and just request a change of accountancy. But I'm not sure, Tina, with that study that we did or not. I'm gonna have to look back on it. All the details that we did, but yeah, happy to revisit that and see some options for you.
Great, thank you.
Cool. Any other questions? We'll do a little overview of 179D, and then we'll touch on R&D as well. And not long for the rest of those. But so what is 179D? 179D is an energy efficiency deduction. And what it means is we're building buildings now that are more efficient than the code requires, and therefore the government says we're going to give you an additional benefit. Angela has known about 179D for a very long time. She probably could tell you more about it than I could, but it is eligible for original owners of new construction, or Tina, if you did $50,000 worth of improvements in your new commercial building, that might qualify for 179D. It's anywhere from 60 to $1.88 per square foot between 2006 and 2022. Beginning in 2023, they potentially $5 per square foot, but it's got a little bit of a catch. It's not quite $5 per square foot, and I'll explain that. What do you look at when you're doing 179D? We're looking at lighting, the HVAC and hot water system, and your building envelope. So they're looking at three areas: lighting, HVAC, and building envelope mainly. If you were to break out and if you said, hey, I just did a lighting project, then you might get 60 cents per square foot. If you said lighting and HVAC, you might get 120. All three, you could get a $1.80, and then it's increased for the cost of living, so it's a little bit higher, 188. Starting in 2023, if you had prevailing wages and an apprenticeship. So prevailing wages is union wages. Most of us are more cost conscious when we build something. So we're not going to do union wages. And that was a political thing that they stuck in. So you had to do union wages and you had to do an apprenticeship as part of it. There is a sweet spot that I'll kind of point out in a second, where you don't have to qualify for the union wages and the apprenticeship. And I'll kind of mention that in a second. Oops. The who can claim it? Any private building owner that built a building or did improvements from 2006 until now. You can capture it just like a cost seg study on those prior years by using a 3115 change of accounting form. So you don't have to amend a return to go back and capture it. The sweet spot, if you started construction before 2023 and you ended construction in 2023 or following, you could qualify up to $5 per square foot. And you don't have to meet that apprenticeship criteria and you don't have to meet the prevailing wages, the union wages. And so that's a pretty cool thing. It's actually up to $5.81 per square foot because of inflation and things like that. And the uh, the sweet spot is pretty cool. So it doesn't pertain to residential rentals. So keep that in mind. But it also does. Let's see if I have a slide on that. It does pertain. Let me go. Nope. It does pertain to if maybe you have a client that is an architect or an engineer or a designer, it could qualify to one of them. So if I'm an architect and I design a church, or if I design my government building in my municipality, the nonprofit could allocate the benefit to come to me as the designer. So that's one situation where the non-building owner could benefit. And the cool thing about that is that, all these deductions we're giving you, when you sell a building, you have to pay them back in what's called recapture. In the case of a designer, architect, engineer, they don't ever have to repay that. The one negative is that in June, any construction started after June 30th of 2026, 179D does not apply, but anything prior to that, it does apply. So that's happy for Angela and I to take a look at that for you and see if you
Absolutely.
might benefit from it. Anything
So
else
if
on
I may,
179D?
yeah, if I might interject just 1 second, because that screen may have been a little confusing. So what he was mentioning about the engineer, architect, and designer, that only applies to entities that are non-for-profit.
Yes.
That because the entities that own those properties don't pay tax, so they don't have a reason to use 179D. And so the IRS and the government has allowed the designer, the contractor, whomever, on a first come, first served basis to take advantage of that tax savings for their company and their entity. So just to make sure no one's confused, that only applies to non-for-profit type of entities to where the engineer, the architect, and the contractor could actually take advantage of that.
I was looking for the slide because in some of my presentations I have a slide that spells that out, and the slide didn't pull up. I pulled it out of this one, but yeah,
You got
that would
me.
apply nonprofits and government entities, and Angela knows what she's doing there. All good. Let's see. Someone asked in the chat for STRs, do they have to be managed by the client owner, not property management companies to be able to qualify? So for an STR, you could do a cost segregation study, even if you didn't manage it, but it would only apply to your passive rent from any of your rental properties. Okay, so you could do a cost seg study and you could use that to apply that. If I have a W-2 job, if I'm a beautician or I'm a contractor or whatever, and I own a short-term rental on the side, the only way that I can use that to offset my W-2 is that if I manage it, not a property management company. So there's a difference. You can benefit either way. But if you were the kind of manager of it, then you can benefit in a special way because you can use it to offset your paycheck, which normally you can't do that. But on STR, if you spend 100 hours or more, and no one else spends more than that time, and you don't have a property manager, then you're able to apply it against your salary, your W-2 income. So that's kind of a unique thing. Good question.
And that falls in line if you're not registered as a real estate professional. If you're obviously if you're a real estate professional, then all of it can go against your active income.
Correct. Yeah, we there's an active bucket and a passive bucket. If I'm a real estate professional, it's all one bucket. If you have a job that you get a paycheck for, like a W-2, then you have active income. The W-2, the salary is your active income. And then any of your buildings that you own separately is considered passive income. In the case of that short-term rental, it crosses lines and you can use a loss, a cost seg study on that short-term rental against your W-2. If you're a real estate professional, it's all the same bucket. It all offs any cost seg offsets any other kind of income. And I'll just touch real quick on R&D tax credits. If you do something else that might apply for R&D tax credits, it's up to 10 cents on the dollar. It's a dollar for dollar tax credit for every qualified dollar. It reduces your federal and your state tax on income liability. If I'm not, if I literally get a tax credit, then I can reinvest that in my building. And when you're doing a startup, like for example, if you're a software company and you pay a lot of payroll, you're paying out a lot and you're not getting a lot in. So it's kind of offsetting some of that as you do it and helping you out for that. Um, I think I have the questions you would ask to see if you qualify for R&D credits. Is this a new or is it a newer improvement process, product, or method? Are you trying to eliminate uncertainty? So, for example, the guy that did the steak company, He would try something and it might work and it might not work. So he was reducing that uncertainty. Is there a process of experimentation? Is it technological in nature? All of those are kind of things that would qualify. And then what are the exact things they do? Salaries and wages, supply cost, and contractor costs. If I had a healthcare company at one time and I paid a contractor a couple $100,000 to develop a software, an app for your phone, that would be an R&D tax credit type of activity, and I was paying a contractor to do that. So pretty cool how it works. Here's just a couple of ideas from firms: equipment developer, engineering firm, manufacturing, software developer, technology, wineries and breweries, restaurants. There's a gentleman in South Louisiana that anytime a hurricane hits, he puts food in people's hands, and he's had to figure out processes in order to do that quickly. And then he also has this kind of convenience store that he'll drop into a plant like Exxon, and you can go in and get fresh sandwiches and stuff out of there. Well, he's had to test out packaging and recipes and what lasts longer, and all that is again activity that qualifies for the R&D activity. Um, and then the one big beautiful bill made some significant benefits that allowed you to take deductions immediately for R&D and get that benefit immediately rather than having to wait a couple of years. That's kind of the change that happened. So this is our one big beautiful bill presentation that talks about all those things that were touched on in some way, shape, or form by the one big beautiful bill. And there's some other things, but these are the things specifically that we can help you with along the way. Any other questions that we can answer for y'all?
One of the things, Warren, if you don't mind me interjecting too, is when it comes to R&D, the term research and development is very confusing because most people think you have to create some new fantastic item that's new to the world to qualify, which actually that's not true. It doesn't have to be new to the world. It just has to be new to you, your company, or an organization, even if it doesn't work out all of the money that you spend trying to figure something out actually counts towards R&D.
Yeah.
So I wanted to just interject with that because there's a misnomer in that space and a lot of people miss out on these credits just because of that.
Cool. So, in summary, cost segregation, bonus depreciation if you own a building, 179D if you own a building, R&D if you're doing research and development. You automatically think too that it's kind of test tubes and pharmaceuticals, but there's a lot of things that would qualify. You're also talking about the repair regulations. What things can you expense as a repair? And Angela and I are very schooled in knowing what that is, probably more so than some CPAs. I'll never throw a CPA under the bus because y'all have to learn way more tax law than I do. I can't do a tax return, but I can tell you a whole lot about depreciation. So that's kind of the way that works, and things like the asset disposition. I think what I tell people is anytime you tear something out of a building, anytime you buy a building, build a building, tear something out or put something in, there's usually a tax benefit that you should be aware of, and you can find the answer by calling Angela and telling her about your project, and she'll do her best. If she doesn't know the answer, she'll run about me, or I've got other team members in our office that know even more than I do. So. Anybody else with questions?
So Christine has a question. She said, "Can we do cost seg and R&D credit on the same property?" So Christine, those are actually two different things. So cost seg would be around the property. R&D would be around the company that are doing any type of work around things that are within the realm of research and development. And that could be if you're building a property, if you're constructing property, and a lot of that could go into it. So it just depends on what you're meaning by doing cost seg and R&D in the same property. Are you the contractor? Are you the builder? Are you the engineer? So that could be yes. So it just really depends on where your question is coming from. I hope that helps and makes sense. Warren, do you have anything else to add to that?
Yeah, you could do cost segregation and 179D on the same building.
Right, but she was
But
saying R&D.
yeah, but R&D is the business activity.
Right.
179D and cost seg are the building itself. And
But yes, 179D and cost seg are often
yeah,
done together on a property.
I had a client out of Destin, Florida, that I've known for years, and the husband and wife team called me about a month ago and said, "Hey, we just built three new warehouses, and the warehouse is qualified for cost segregation and 179D. And the difference is that when you do a cost seg, you're identifying the 5 and 15 year assets that can be accelerated. When you do a 179D, you're identifying the assets that are more energy efficient, and those are 39 year assets. So you're able to accelerate or take, through 179D deductions some of the 39 year assets that you normally would not be able to do. So that 179D cost seg combination is pretty good. And doesn't it really needs to be a big imprint, meaning 30 or 40,000 square foot or multiple properties that are 10,000 square foot in the same area. And yeah, it's pretty cool. Other
Yeah,
questions?
that's a great question. It's a
Yeah,
great
thanks,
question.
Christine.
Yeah, thank you for clarifying. I'm actually based in Charlotte, North Carolina. I am a licensed realtor, and my family has a couple of properties that we've been doing COSAC on, but obviously want to know more in-depth knowledge
Yeah.
about this topic. And, since this is mostly federal law, my understanding is that you could also work remotely with potentially my clients who are, buyers and investors in Charlotte, right? So I guess I could be reaching out to Angela after this, and we
Absolutely.
can see how you could potentially work with my clients who make a lot of income in their W-2. So they want to buy something and offset that tax.
Absolutely. Yeah, we do a free analysis. So I just need a few pieces of information and I can give you, based on our 60,000 plus studies the past 23 plus years, we have a benchmark data that is very, very accurate. And so we can give those numbers to you that you can provide to, even if you have clients that are looking to purchase property and they
Mm-hmm.
haven't done it yet. I have a lot of agents and brokers I work with that I give them those numbers to help them sell the property.
Mm-hmm.
So happy to do
Yeah,
that.
we do that quite a bit. People will call us and say, I need a lot of deductions, and they're a real estate professional. What's the best asset to buy,
Mm-hmm.
and we'll
Right.
coach them through that. And then yeah, Christine, we get a doctor whose wife doesn't work, so she'll be the one that's active 100 hours, him or her, vice versa. Or I recently just had a doctor team, husband and wife, and they said, yeah, we're both doctors, but we're the ones that manage the property and we're the ones putting 100 hours. So they bought two short-term rentals and they're using it to offset their income as a doctor. So they're
Mm-hmm.
not real estate
Mm-hmm.
professionals, but the short-term rule works for them.
Yeah, absolutely.
Yep. Sounds great. Yeah, because I'm more familiar with the banking industry, and bankers make a lot of money.
Yeah.
Um, that was going to be my niche for investor clients.
Oh, perfect. I actually work with a lot of bankers that send their clients my way, and
Mhm.
we've helped a lot of them. And we guarantee our work, and that's why we have a flat fee, and we don't have surprises. And audit support is included in everything that we do because, like we've mentioned, we've never been audited in over 60,000 studies, 23 plus
Mhm.
years, and that's because of the way we do what we do.
Mhm.
And so we pretty much, I add an additional guarantee myself because I own my own consulting firm the past 15 years, and I specialize in tax incentives and cost segregation and working with CSSI is 90% of what I do. And so I'm so confident with my clients that I actually put my own money where my mouth is and I back up everything as well.
Awesome. All right, I will shoot you an email after this. Thank you.
Perfect. You're very
Yeah, and
welcome.
just to touch on what Angela said, the process, if you said, hey, I have a building, it takes us a few days to run an estimate. We don't charge for that. The estimate will say, here's the tax savings, here's the fee. If you want to move forward, we ask for a sign engagement and 50% of the fee. Takes us, call it 4 to 6 weeks during tax time, 2 to 4 weeks every other time of the year. And we're going to ask you for, do you have an appraisal? Do you have blueprints? What's the purchase price? We refer to the cost basis, and that would be purchase price minus land plus any improvements. We send somebody to do a site survey, and then we do the full report and hand it to you and your CPA. And sometimes the CPA does not know what to do with our report, we'll walk them through line by line. Here's where you put this number. Here's where you put that number. And
Yeah.
so we're doing that a lot right now with tax time. A lot of people are wrapping up their cost seg studies. We're more busy than we've been in years because of the big beautiful bill, and it's all kind of culminating right now. We'll be busy throughout the year, I think, this year, but
Yeah.
it's a nice place to be, and the big beautiful bill helped us a bit.
Yeah, absolutely. And I also like to add, um, when I get the few pieces of information that I need for you to run the calculations, we can run through a simple calculator and I can give that back to you in 15 minutes, but I don't like to run it that way. And the reason is there are a lot of things, especially with all the clients I work with that are doing short-term rentals, say in the Smokies or whatever, and they have this beautiful home with an indoor pool and wood floors and like it's a true log cabin. But the one thing that happens is you remove a lot of your 5-year asset because of that big, beautiful indoor pool and those big, beautiful all wood floors and ceilings and everything else. It's good for cash flow for that property. But when it comes to cost like study, the IRS now sees a lot of that as a 39-year asset that considered structural. So it cannot be included. So I still like to do the old fashioned route where I send it to my analyst and I give them a link to your property so they can actually see the interior and exterior so we don't have any surprises later. Because I'd rather you be really excited about having more in tax savings than being really upset because we missed something. And so I just always want to make sure that my clients or anybody I deal with know that I won't get it to you in 15 or 20 minutes because I want my analyst to look at it every way possible so we don't miss anything. So I hope that makes sense. Warren, do you agree with that?
Yeah, our calculator is just based on the averages. If you've got
That's
a
it.
unique
Yeah.
property, handing it to the analyst and take 2 to 3 business days usually to return that.
Yeah.
That's a good way to do it.
Yeah. It's the safest way. And because they can't see, like the calculator can't see the things that I just mentioned that could be missed. And so
Yeah.
I'd rather take a day or two to get the real accuracy from the analyst than just plug numbers into a calculator.
It's
Cool.
good.
Well, that's all I've got. Any other questions or
I'm
good
good.
stuff?
Thank you so much. Very informative.
You bet, Tina.
Great.
Thanks for having us again. And y'all see Angela's contact info up on the screen. Reach out to her if y'all have questions. If she needs backup, she'll call me in. But otherwise, she can take great care of y'all.
Absolutely. And it would be an honor to work with you and your clients. And we will have this recording that we can send over. Or actually, Tina, you might have it too since it's your Zoom. But I want to make sure that you had this to share with all the folks that couldn't join us today. And just reach out with any questions that you have, and I can help walk you through anything.
Sounds good.
Good stuff.
Thank you
Thank
guys.
you. Thank
Oh,
you
now
so
I see
much.
your puppy, Warren.
It's my girl puppy. I'm babysitting her.
Oh
So
my goodness. Is that a
Thank
Springer
you.
Spaniel?
she's a long-haired dachshund,
Oh, so cute. Anyway,
Mina.
but
She's been having fun. I drive her in the car and she sticks her head out the window and the wind's blowing and
that's what
she
I
has
do
fun.
when I'm in the car. All right,
Good
guys, you're
stuff.
the best. I appreciate you. Have a wonderful and blessed
Thank
day. Just
you.
reach
Thank
out with
you
any
so
questions you
much.
have. Thank
Thanks,
you.
y'all. God
Bye,
bless.
guys.
Bye bye.
God bless.
Bye.
Bye.